Hey guys, how's it going? It's Raf here. In today's video, we're going to talk about CFD, which is a financial product which can be a little bit complex to understand, but we'll try to explain it in a way that's easy to digest. To start with, CFD stands for Contract for Difference, which means that it's a contract between the buyer, the person who opens the CFD, and the seller, which is the broker, and this contract is applied to a certain asset, which could be a stock, currency, cryptocurrencies, index funds, and also commodities such as gold, silver, and oil. In this contract, the buyer can establish that the price of that asset will go up or go down, and once the contract is closed, if the indicated price of the buyer matches with the current trend, the buyer gets the positive profit on the difference, and in case it's negative, then the losses are proportional to the difference in the price. Meaning, this is not like the binary options where it's black or white. Instead, the gains or losses will be based on proportion with the difference on the asset price once the contract is closed. We can say that it's similar in the way we traditionally buy stocks, but with three main differences. Number one is that you don't actually own the asset. So for instance, if you have a CFD on Apple, you don't really have shares on Apple, but it's just a contract with a broker speculating that this asset will go up or down on price. The second difference is that unlike stocks, in which we buy a share of a company for a specific price and then we expect to sell it for a higher price, the CFDs allow you to make more profits even if the stock goes up or down, in both ways. When the trader thinks the underlying asset will increase in value, we call it a call operation. On the other hand, if we are going to make money expecting that the price will go down, then we say we are opening a put operation. The third difference is that with CFDs, we have the possibility to operate two CFDs with leverage. Leverage meaning that the increase or decrease of the value for, let's say for example, 1% of the asset price, we could win or lose 5, 10, or even 20 times more, depending on the leverage we are using. That's why CFDs are a risky financial product, as it can provide great profits in short periods of time, but at the same time, if the price goes down, it can provide great losses as well. Okay, after explaining all this information and definition about CFDs, I think the best way to explain it is with an example. We have our friend Dave that has seen that Apple stocks have risen quite a bit, and he believes that in the next days the price will get corrected and the prices will drop. He opens a CFD on short or put operation to Apple with a 5 times leverage for a price of $220, which would be the current price of Apple, and he puts an amount of 100 euros. After a couple of days, the market seems to agree with Dave's prediction, and Apple shares are priced around $200 now, meaning a 9% decrease from when the CFD was opened by Dave. He decides to close the contract, and we'll see now how much he made in profit with this operation. Do you remember that the decrease in value was of 9%? However, this is not what Dave's going to make in profit because, as we mentioned earlier, he leveraged his money 5 times. So in this case, he'll be earning 5 times the difference in price. So he's getting 45% over what he originally invested, which was 100 euros. So he gets back his original 100 euros invested plus 45 euros on profits. It's worth mentioning that if Apple shares had kept going up and after 2 days it would reach the 240 euros and Dave decided to close the contract at that point, he would be losing 45 euros instead of making them in profit. A lot of you might be wondering, in this scenario, what will happen if the share keeps going up but Dave decides to not close the contract? Well, we have a European regulation in regards to this type of financial products known as ISMA. One of the things that this regulation controls is that the investor can never lose more than what he initially invested in this operation. So, in the example we showed earlier, if the losses were going to be more than 100 euros, then the contract will be closed automatically, not allowing to lose more than what was originally invested. However, we recommend always operation with stop and loss orders and take the profit. Also note that the ISMA regulation is applicable only to European countries, so if you live elsewhere, you make sure you read your contract conditions and your local regulations. Another thing that ISMA regulates is the restrictions on how much leverage you can apply depending on the asset. So for index and gold, it's 20 times, for cryptocurrencies 2 times, for commodities 10 times, and with the stocks, as we seen earlier, 5 times. If you are starting to use this, please remember to start with small amounts like $100, $500, and once you get more familiar with the operations and get a crack on it, start with higher amounts, because as I mentioned, thanks to the volatility of the assets we invest, we can earn or lose a lot of money quickly.